In today's headline highlights, I'm covering some major stories that will definitely be changing and shaping the housing market, not only locally, but globally. From massive layoffs to China's real estate sector, these stories will have an impact on the real estate industry in the coming months and maybe even years. So let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty, and today's stories are going to open some eyes as to what's going on behind the scenes, much of which isn't really regularly being reported on, that is and will have an effect on real estate for quite some time. So if you haven't already done so, please consider subscribing and hitting that notifications bell to stay up to date on the latest news and developments shaping the future of the housing market. And now let's start off with our first story on the millions of layoffs ahead of our economy. According to Zero Hedge, millions are about to lose their jobs. At some point, the Fed will realize that it's simply impossible to contain the supply-driven inflation through stubborn rate hikes, which instead would lead to a dire alternative, millions in mass layoffs and newly unemployed workers, which again is also something that I have been really saying for quite some time, well over a year. The Fed now has begun revising its 2% inflation target higher, move that will definitely send risk assets from high beta trash and meme stocks to blue chip icons to Bitcoin and cryptos limit up. At some point, the Fed will concede it has no control over supply. That's when we will start getting leaks of raising the inflation target. And nobody expected the Fed would be hiking rates like a drunken sailor until sometime in late 2023 or 2024, which, as we know, obviously has started much earlier than that. But one of the big things here is obviously that, and we've gone over this in a few of the charts, every single time the Fed tightens or has a tightening cycle since 1913, it's always really ended in disaster. And they've always, as you can see from this chart, they've always had to reduce their rates, even though right now they are starting to get back to the last highs that we saw in 2018 and going into 2019. People keep forgetting as well that the Fed's intention right now is to really spark a recession. So that is going to lead to millions of Americans losing their jobs. A few today can conceive of a world where inflation is zero or negative and is instead replaced with millions in unemployed workers. To bring price increases down to 2%, we may need to tolerate unemployment of 6.5% for 2 years, according to this report. The paper shows why the Federal Reserve will likely need to maintain its war on inflation, even if unemployment continues to rise. And the scariest part of the paper is when the authors use their model to forecast the unemployment rate that would need to be needed to bring inflation down to the Fed's 2% target. It would require an average unemployment rate of 6.5% in 2023 and 2024, would really translate into no less than 10.8 million unemployed workers, which is an 80% increase from today's 6 million. So that's an additional 4 million unemployed workers from now until 2024, which would be a huge increase and definitely have an effect on the housing market, considering a lot of people have purchased homes in the last couple of years at all-time highs, at record high prices. You compound that with the fact that real wages have actually been decreasing because of inflation. I think we're going to see those layoffs leading to a lot more inventory coming to market, which is going to drive prices down even further and also create a huge economic turmoil in the near future. With this story also came out this morning, the CPI data came out this morning. A lot of people are expecting the CPI data to go down from, we were at 8.3 before, 8.2 before, and they were expecting it to go below 8 or around 8 this month. The bad news is that it actually went up slightly. The increases in shelter, food, and medical care indexes were the largest of the many contributors to the broad-based increases, mostly offset, though, by the decline in gas and energy prices. The food index continued to rise, increased 0.8% over the month as the food home index rose 0.7%. The energy index fell 5% over the month, with obviously gas leading the way, but the electricity and natural gas indexes actually increased. In our third story, I wanted to talk about the foreclosures. So Foreclosure Starts, that is not actual foreclosures coming to market, but these are just starts, have reached pre-pandemic levels nationwide. 34,500 U.S. properties started with foreclosure filings, default notices, scheduled auctions, or bank repossessions, which is up 14% from a month ago and up 118% from a year ago. Foreclosure starts have almost returned to 2019 levels, said Rick Sharga, Executive Vice President for Market Intelligence at Adam. Adam is one of the leading data companies for real estate and more specifically for foreclosures. Where have the highest foreclosure rates been seen? Illinois is number 1, Delaware number 2, South Carolina 3, New Jersey 4, and Florida 5, where Florida has one in every 2,950 housing units going into foreclosure starts. The other thing is foreclosure completion numbers also increased 28% from last month. Keeping right along with the real estate and the housing market, rents are starting to lower, but will it last is the question. We're not seeing rents go up as quickly. The rental market is softening a little bit, but the national median asking rent was up 14% in July over July the previous year. While that percentage is still high, it has decreased from 15% in June and 16% in May. So we've been decreasing about 1% each month. Cities in Florida, such as Boca Raton and West Palm Beach, have seen rent decreases negative 0.1% and negative 0.5%, respectively, compared to last month. But the Bank of America CEO Brian Moynihan said high rents are a concern because they can account for a big chunk of households' take-home pay. And rent obviously could be up to 40% of households' income, which is going to have a huge effect on the economy as a whole, because if you're spending more on your necessities and your shelter, then you're not going to be spending money and other things in the economy to keep businesses going. All right, our next story is the world's hottest housing markets are facing a painful reset. We have been talking about this for a while, but millions of people who borrowed cheaply to purchase homes during the boom over the last 2 years face higher payments as loans reset. Now, this doesn't necessarily have to do with the United States specifically, but this is more of a global phenomenon that's happening. Frothy markets such as Australia and Canada are already facing double-digit house price declines, and economists believe the worldwide downswing is only getting started. We will observe a globally synchronized housing market downturn in 2023 and 2024. Hideki Harada of Hosei University, a former Bank of Japan economist, he warns the full impact of this year's aggressive rate hikes will take time to play out for households. Moving on to the next story, Evergrande. Crisis deepens after the lender seizes headquarters. This is brand new news that just came out 2 days ago. Evergrande's Hong Kong headquarters have been seized by a lender after the struggling Chinese property developer defaulted on a loan and twice failed to sell the building, according to 4 people with knowledge of the matter. So the appointed receiver has not been named, but the property itself is valued at $1.2 billion, and they are planning to force the sale. So as liquidity crisis gripped the Chinese property sector, we talked about this about a year and a half ago, Evergrande has twice attempted to sell the tower. Now, going along with that story is the mortgage boycotts that are happening in China. If you take a look at this picture, this is just an example of the types of areas that have been under construction for quite some time that are just remain unfinished. We've also seen, you can look up footage of it, entire areas in cities like this where all of the buildings were actually destroyed. So the sweeping mortgage boycott changes the face of dissent. Obviously, dissent in this particular political party is not favored. A mortgage boycott by hundreds of thousands of middle-class Chinese has become a 5-alarm fire for authorities. It just began with a 590-word letter because the developments that were under construction had been halted. And at the same time, what a lot of people don't understand is that in China, a lot of these buildings are prepaid, in some cases completely prepaid, before they're even constructed. But also, as a lot of these citizens are paying the mortgage while their home is being built. So when you're still paying your mortgage and the home is no longer being built, you start to get fearful, especially with everything that's been going on with the real estate sector in China specifically. So all home buyers with outstanding mortgage loans would stop paying. That was what they wrote back in the letter. But what it actually had a domino effect and led to other provinces. Within 4 weeks, more than 320 projects in about 100 cities were facing similar protests. which again is almost like a self-fulfilling prophecy. These companies that are facing these issues with liquidity and actually being able to complete projects, they are already running out of money. And what they've been doing is, I won't call it a pyramid scheme, but it's similar structure. They've been using present money that's been coming in to pay for past buildings. So that has to stop. And when this stops and when people stop paying their mortgages, they have no more money coming in. Well, that makes it really difficult for these companies who have been using that type of deal structure to complete their projects. So in a way, it does become a self-fulfilling prophecy. However, the Chinese government did say that they are requiring these companies to complete these projects at whatever cost, including selling off assets. So those are the main stories for today, but I did want to touch on a couple other smaller things that are happening in the news to keep an eye out on. One is more pending homes are falling through right now. That's also happening across the board, not in just resale properties, but also new construction. So there are a lot of huge incentives that have been coming out, but now a lot of builders are starting to resort to price declines, which is one thing that they really don't want to do. And that's really a last resort. Another thing to keep an eye on if you are in the stock market, this is a tweet from Sentiment Trader. In 22 years of doing this, none of the charts they have looked at have stood out like this one. What this graph is indicating is the amount of puts or sales of stocks. Lots of hedge funds and companies are now actually betting against the stock market. And you can see how extreme this has gotten. This is worse, way worse, 3 times worse than 2008. I always say to follow the money because that's, usually smart money, makes their moves well ahead of time. And if this is where the market is heading, or the stock market is heading, I'd say, it might not be a great time to be in individual stocks. This is not financial advice. I'm not an advisor, a financial advisor. Please don't take that and take it with a grain of salt. But I just thought that this was an interesting graph to show. Another story that is developing right now, and it comes due this Friday, massive rail strike could happen this Friday. Which obviously the concern would be it's another blow to the issue that's going on with supply chain. Unions are poised to go on strike on September 16th and would bring nearly 30% of the nation's freight to a grinding halt. Obviously, the concern here would be empty shelves in stores, temporary closures at factories who need parts to operate, and higher prices due to the limited availability of inventory and consumer goods. Well, that's it for me today. If you got value out of today's video, please hit that like button. Don't forget to subscribe so you're notified of my latest video releases. And let me know in the comments section what your thoughts are on these stories and whether you're seeing signs of this stuff happening around you. Thanks again for watching. And until next time, stay safe, stay positive, and more importantly, stay free.